we doing? I'm gonna be honest, I'd already started the video and then it went wrong, so I've restarted it because I accidentally turned the bloody computer off by the wall the other day and my spreadsheet disappeared, so I've had to pull it all up again and try and find it. So where I was I was just about to start looking at Leggett and Platt. Wasn't really a lot on this that I seen that I liked, to be honest, but I did notice that on the on Where Wisdom, on the people that own it, is Toll and Company, or for anybody who's watched Keith Gilroy and Kitty's videos, Toll is one of the funds that he would follow. So even though there was nothing in it that I particularly liked, I was just interested to see if there was anything that they liked. So they only bought it for quarter for a stone Q4 2025. They paid $9.73. I think this is an estimate. Yeah, it is estimated actual price still at the top. Still got cold as well, as you can hear. Insider buy-in as well, not since 2024. I mean, they haven't lost an awful lot, have they? But it's not great. If you've put 300,000 in as a CEO, I'm sure 2 years later, you're expecting something to have happened with your money. 11.48 as opposed to it declining. When was that? 2024. Yeah. So they obviously thought it had bottomed around there, and clearly it hadn't. That's something to know as well, actually, if that a few of them, where was it? A few of them were buying around about here. If they thought it was cheap then, why were they not buying when it got, down $7? Like, it's the sort of, I've heard Lee Lu talk about it before. If you thought it was cheap then, I think Joel Greenblatts spoke about it as well. If you thought it was cheap here and your thesis has not been broken, why don't you think it's cheap here? Like, why aren't you buying more if you think the market's giving it to you cheaper if you think that you're correct, I know they say don't catch a falling knife, but value investors have time on their side, don't they? You're not expecting this to go up within a month, 2 months, 6 months. Generally you're looking 2 to 3 years. So, I mean, and longer, definitely, and longer. But yeah, I just find that a bit interesting that they were all willing to be purchased around here, but not willing to purchase when it got cheaper. There is some sort of restructuring going on as well. Discipline strategy focused on operational fix. Lower sales but improved margins and cash flow supported by cost reductions and a robust balance sheet. Now, let's see how robust that balance sheet actually is, because there is 1.5 billion in long-term debt. They've got 600 million in cash, though, to be fair. What would you say, close to a billion with receivables? You're not going to take all receivables, are you, in a liquidation? You're not going to regain all of them. But especially with the inventories, you've got at least a billion. Depends what the inventories consist of. I don't really... I've put it into ChatGPT. I should start a new bloody conversation, actually, with this. Let's try again, start a new conversation. I always start a new conversation because when you go back through, you can try and find it easier. So, bedding products, furniture products, automotive parts, seat support systems, lumbar back support components. Okay. Got quite a wide range of what they do then. High dividend cyclical industry. I don't think it is very high dividend. I'm sure they've said this one here. There you go. Quarterly dividend of 5 cents. It's not a lot, is it? High dividend. Yeah, maybe it's been cut. I don't know. We can have a look. Actually, I've got dividend on it. Oh, it has been massively, massively been cut. This I don't like though. Basically, got no downside protection with the amount of debt that they've got. So, at $10 a share and only 23 cents in tangible book value. For me, it's pretty much a no straight off the bat. Gross margins have been slowly declining as well, as have revenues. Operating margin declined. Simple free cash flow margin. This is the worrying thing for me. The consistent negative tangible book, and then, yes, all right, it's headed in the right direction, which I think is from selling parts of their business. If we have a look on the cash flow statement, in the last 12 months, proceeds from disposal of aerospace products group and proceeds from disposal of assets and businesses. So they've sold 300 odd million, what's that, 340, 350 million's worth of business by the look of it. Did their debt go down then by a similar amount? Yeah, it did. Ish, 300 million. Yeah, okay. So it looks like that potentially has just gone straight off the debt, which is a good thing, obviously. Current maturity, long-term debt. Pardon me. My videos are going to sound so professional. Didn't pay a lot of debt last year either. Operating leases, how much of this is? Oh, leases underneath. Okay. I've heard Michael Burry and Keith Gill argue for operating leases, muddying up the balance sheet, making it appear worse than it is, because yes, you've signed a lease, but you could potentially sublease it, so you're not potentially on the hook for the entire 100 million. If you needed to get rid of some stuff, you could close a property or something and sublease it, so you'd still be earning an income on it, which means that the operating lease is not a true, you could end up earning a profit on it. So they don't like counting it as true debt, because it's not interest. It's not like it's the same as long-term interest-bearing debt. And I do pretty much fall into the same category after looking into it. I did spend quite a while see both sides of the story months ago now, and that is sort of where I fall as well. In the, yes, it's debt, but it's not true debt. There are ways around it, whereas there is no way around this. You're paying it or you're in trouble. Like this, goodwill's very high. Obviously made some acquisitions. Doesn't look like it's been wrote down though, does it? Let's have a look what it is on long term. Oh, it has been wrote down massively. 800 million, 600, 700 million down to, they have had some huge write-downs. If this data is correct, they've had some huge write-downs. Supposedly 192. EV is $1 billion higher because of the amount of debt. What's the historical level free cash flow then? So it's actually normally pretty good. Bad year last year. We can have a look actually and see. This is on here, isn't it? 2024. A huge loss, so that it's going to be, impairment. It got 700 million impairment. That is not small, is it? Goodwill impairment, in that you've paid way too fucking much for a business that has not brought you the benefits. Oh, close to 700 million in impairment. But then, I suppose earnings still would have dropped off massively from operating activities year on year. Bloody 400 million impairment there as well. I mean, that doesn't look good, does it? 1 year, 140 million, 676 million next year. But obviously, all of this is not actually, that's not cash that's been lost to the business now, in the now. That's historical money that you've paid and you've made bad acquisition or multiple acquisitions. So really, there's not a lot else in this cash flow statement to infer anything else other than this could be capex. As both of these are proceeds from disposal. Pardon me. Although capex has come down considerably. It's half of what depreciation is. Now it should be in line-ish with depreciation. As it is not. Are they sort of not investing in the business properly? What is it historically? Statement down here, investments in PP&E. They have had some years where it's less. You want 113. The data's right, at least in these 3 years. Depreciation, amortization, long term. I mean, it was tracking it back then. It's sort of not here. Is that in line with when revenue started to decline? Yeah. I mean, that could just be coincidence. Doesn't necessarily mean the two are related, but where's inventories over that time? Come down considerably as well, so that is another reason why your capex could come down. That looks ridiculously high here, 2021. We are now more in line with we were historically. EV multiple, simple free cash flow, 10 years. See, that's not, for me, not sure what Toll's seeing in this. I mean, that's not bad, is it? A return on capital of 13-14%. It's better than a bond. It's way worse than what it was historically. Cough again, hang on. 10 years to purchase the company outright, debt included, which obviously is included. A multiple of 10. Even on operating unlevered earnings, is 10 as well. And this for me is not something I like. There's no liquidation value in this business. There's probably some reproduction value, but I can't imagine it's close to price. And this is so low, I don't know, I'm interested in. The only thing I'll do is I'll see when the debt is due. Payment charges, see what happened there. No goodwill remaining on hydraulic cylinders. 20% exceeded its value. Aerospace reporting unit. This unit was held for sale and its fair value exceeded its carrying value by 48%. Okay. Home furniture reporting unit exceeded its carrying value by 34%. Goodwill associated with this reporting. Okay. So that's good. That, exceeded its carrying value by 29%. Okay, so there's some businesses that are doing well, I guess. The guessing part of that should show you that I don't know what I'm doing. If you aren't aware, right, I am not a professional. I'm literally a bloke who has read some books, watched some videos, watched some podcasts, found some investors that I like and read anything that they've written, and I'm trying to see whether or not I can do it myself. That's what's happening. So, 500 million next year, which they can afford. Can they afford? They should be able to afford it. If not, they should be able to take a decent chunk. Yeah, should be able to take a decent chunk out. Obviously, you can't spend all the cash because some of that cash is required to grease the business. But when you see that they historically only carried 200 to 300 million, there's a significant portion of that business that could be, that maturity that could be paid off. But then you've got another one here. Only a couple of years later of a similar amount. What's historical free cash flow? I mean, it used to be really high. 500 million in free cash flow when revenues were more than what they are now. Go back further. 200, so we are now back in line with historical norms. Pardon me, a couple of years where it was really high. And then, huge drop off. I mean, I think you'd be hard pressed to say that this company's in trouble. They're certainly going to have to do some refinancing, I would say. But they're pretty historically free cash flow positive, in which case they're probably not going to struggle with refinancing. But there's no downside protection for me. I think Toll as well is a value firm, so it surprises me a little bit. Let's have a look. All cap aims to maximize long term. Deeply discounted relative to their earnings potential. Okay. I suppose it depends on what their time frame is, because if they think that they're going to get rid of some of this debt and deliver the balance sheet, and they're still going to be earning 200 to 300 million a year in free cash flow 5 years down the line, which is past the maturity of the stock, the maturity of the debt, then yeah, it would sort of makes some sort of sense. 100% of the firm told must meet professional standard care. Okay. Problem is, I don't pay for Wet Wisdom, so I can't see what their long-term returns are. Performance last 4 quarters, 14%. Okay, maybe I can see it. Interesting. Don't really understand performance quarter over quarter. Don't really understand what this is. Just showing their assets under management are down considerably, but that could just be that they had some positions that really paid off and they've sold them. Pardon me, as opposed to people pulling their money out. Yeah, there you go. Look, it's not. They're not on there, are they? Or are they on there? In which case, they're not doing very well at all. I don't know what the whale means. Is that them? Can someone explain that? I don't know. I'm not sure how it can be minus 14%, but here they're saying they're up 14%. Minus 16%. Yeah, I don't know. I don't really know how that works. Is anyone saying anything about it? Sell, hold, buy. One buy last year. Reconstruction efforts are working out. He was a hold before that. And he's a hold again now, actually. Oh, okay, so there's an M&A offer, is there? Cigar butt doesn't offer enough. I don't even know that it's a cigar butt. There's not enough. 26% rally. Earnings contract. M&A remains potential catalyst, but current cash yields. But multiples do not offer compelling deep value. Yeah, see, that's what I'm saying as well. The multiples aren't there. Very challenging prospects. I mean, to be fair, I can't disagree with that because I haven't looked into what the forecast for the company is. But still managed to generate some cash from operations. Yeah. High level of shareholder yield. Down. Okay. Sales down 11%. Really committed to initiatives, for instance, there. Reduce its net debt from 1.5 to 900 million. Oh, net debt, yeah, okay. Yeah, okay. So that is a positive. We've already mentioned that. Costs have actually fallen. We've mentioned that as well, but I don't know if that's good or bad. True healthy future. Management sees another decline in top line earnings per share. Capturing efficiencies and optimizing the portfolio. Cannot be convinced that Leggett Platt will be a company that can deliver consistent results, solid revenue growth in the next decade, healthy margins, and consistently a return. Yeah, because we've pointed out as well that the margin's down. Residential market is not doing so well, and they can capture growth, but it also seems very intangible to me. Cigar, but maybe is a leverage. I mentioned earlier, it's not exactly bad. Yeah, I don't see the debt as a huge problem. It appears that he's saying that as well. Using the bottom of the guidance, we're talking about an operating cash flow of 225 million, capex of 100 million. Leftover shareholder market cap is 1.5. In other words, its free cash flow yield is less than 10%, which seems too low. Yeah. Yeah, well, that's 10 times multiple, and at 10%, 10 years to pay it off, which for me puts me out of it. It's not a fast enough return. We'll put Moni for Bry out of it. That's where it's not a fast enough return comes from. Moni for Bry, don't know if you've read that, no investor wants to be paid back within about 3 years from earnings of the business. as he's viewing it as if he's buying the business, obviously. So yeah, a cash flow yield of 10% is a multiple of 10, and that's not cheap. 10 multiple of 10 means that if you buy the business, it's going to take 10 years for the cash flows to pay you back at the purchase price, the given purchase price. So I gotta be honest, I feel like I'm in the same place as this. Yeah. M&A is a opportunity, but you can't depend on it, is what he's saying. And then approved by all the people that could get in the way of it being approved. Look, he's listing there. Sorry, I'm just trying to get a drink. There. I am leaning towards agreeing with this and not with Toll, but you don't know what Toll's time span is. But for me, I do semi-agree with most of this. I don't like this. And I don't like this. 10 years, even on unleveraged. So it's going to be a no on Leggett and Platt. I know the number one rule is to understand the business, and I haven't really looked into understanding the business, have I? But first of all, before I want to understand the business, I have said that I need, where is it? Is this going to load? Here. So, downside protection. I need to see downside protection, and then I can go into it further. So, pardon me. So instantly looking at balance sheet, maybe cash flows. That's basically the only two things that's going to give you the downside protection, either in liquidation or reproduction value or great return on capital. If I can see something that does have that, then I will go into trying to understand the business. So I feel like it's a bit of a roaring kitty approach, actually. I think the first thing he says that he ever did was straight to the balance sheet, see what you're dealing with, and then after that you can go from there. Right, okay. Right, well, I mean, it wasn't so much saying no fast, was it? I could have said no a lot faster as soon as I seen those things. Spent half an hour on that, whereas last video we were saying no quite a bit quicker, weren't we? Definitely worth putting in the spreadsheet though. We've got a few things I've really got to catch up on with putting in the spreadsheet. Maybe what I'll do, what colours have I not used? Do light blue maybe to show that we've been through it. I don't know if for 6 months of the year I'm gonna start making I'm gonna start tagging stuff that I've done. Every time you reload this it goes back to the top. And to be fair, these do change because it's done on live prices, so obviously your metrics are going to change depending on the live price, but it is a bit annoying when you think, oh, have I looked at that? Have I looked at that? What else have we got? Oh, I'm not interested in that. That looks like absolute dog shit and there's not enough data available. Business solutions. So I'm just going to fuck that straight off on a red and don't bother looking at it. The other investment past asset management company. I mean, that is huge. They've obviously done really well with COVID and then awful since. They do. Mutual funds, managed accounts, not interested. development, another one I'm not going to be interested in. It's just not enough data, and when it doesn't look like manipulation. Um, when did I look at this? I put some stuff in here. That's a long time ago. By the look of it, 2020, October 2024. Wow, over a year ago. What are we looking at? October 24. What about here? Well, would have been a double. Look, close on it, wouldn't 50%. Okay, well, I've obviously put that on the blue list a while ago. I haven't looked at that since 2024. This is what I mean. This is a problem with these bloody flags on there. Is that I can't remember how long ago I looked at it. Offshore partners, shuttle tankers, long-term charters. Okay. I mean, this certainly could have been an asset play, I'd imagine. It's quite a nice upper channel there. Not that we rely on technical analysis at all, but that would have been it. Out higher. Alright, let's get a balance sheet up for this. KNOP. Aberdeen, UK. Balance sheet. Oh, fuck it. That annoys me when it goes all the way over there. Pardon me. 66 million in cash. 1.5 billion in vessels. Total assets 1.6 billion. Total liabilities. What sort of vessels do they have? Let's have a look. Have I wrote that down or not? Vessel size is huge in your like liquidation value and all that sort of thing. Shuttle tankers, I think, are quite small though, aren't they? Operation acquisition of shuttle tankers. Let's Google them and see. Not offshore partners. Not offshore partners. I mean, I don't know about you, but that does not look like a shuttle tanker. Almost looks like a VLCC. Yeah, they do have shuttle tankers though. I mean, I can't tell. I suppose you can't tell from that photo, but you got a helicopter pad there. Our vessels. Suezmax, yeah, they're big ships. Suezmax. They got quite a few. Aframax, Suezmax. Wow, they got some vessels. Okay. Coverage, charter coverage. Contracted revenue, full contracted revenue of effectively a billion. Average remaining firm charter years 2.6. Billion in revenues. And what's the market cap? 351 million. Excluding contracts agreed after this date, forward contract revenue of 903. Remaining firm charge. Is that? Oh, hang on a minute. Is that? It's difficult to sell, isn't it? Is that a billion over 2.5 years? In which case, it's not so huge considering the price. Anticipated dry dock, vessel age. How old are these vessels as well? That makes a big difference to their. Well, it doesn't look. Because generally nowadays everyone wants carbon scrubbers on their vessels. But 2020, 2022, they've probably got them. Even 2017, they've probably got them. This might not. Let's Google. And were carbon scrubbers a requirement for vessels? Were common though not strictly mandatory requirements of 2020. Yeah, so sulfur emissions, tight restrictions since 2015. Okay. Possibly not scrubber fitted then. I'd say almost certainly not, unless they've done it retroactively. The reason why I'm saying that is because if you look at second-hand prices of ships, because I have done a couple videos where we've looked into some oil tankers, when you look into it, the price of the ship without scrubbers is significantly lower than ones with scrubbers. So if you were to do like a reproduction value or a liquidation value, I mean, what's the useful life of, oh look, useful life of an oil tanker? Or do they before they send them for scrap? 20, 25 years, okay. So they've still got quite a lot of time left in there. Maybe not the 2011s. Most of their fleet has still got some years left. 27, probably not. Okay. Alright, well let's pull the data in on this. Notes 10 and 19, we've got to have a look at this because I can't remember if shipping companies actually have a reasonably recent value of their ships. Net of accumulated depreciation, notes 10 and 20. 1.5 billion in ships, 735 million long term. Okay, you could end up with an asset play on this. We'll have a look. Note 10 and 20. Which one's like vessels and equipment? Is that number 10? Yep. The book value, effectively a pledge of security, partnership's long term debt. Okay. So any debt that is taken out against the ships, they lose the ships as they default on the debt, is what I can potentially take from that. Yeah, are pledged as security for the partnership's long-term debt. Okay. So, 100% interested not. Company that owns and operates. You can do this, look. Not that. Come on. Start a new conversation again. Straight off the bat. Explain not. What is it again? Offshore partners. Where am I going? Over it. I just do this at the start, just so if I come back to it, I can just have a brief synopsis of what the business is. Buys vessels often from its sponsor, earns income operating them, okay, standard. Closely tied to its sponsor, okay. The sponsor supplies ships, manages operations, is the largest owner. Okay, so is that in here? I don't think we're going to get internal buy-in on here. It's not going to load anyway by the look of it. Who owns this? 100% nuts and offshore tankers, okay. 100% of their portfolio. I mean, some people got some serious ownerships in this. And then it drops off massively. Yeah, nothing on there. I have got some websites that would do UK Insider. See what the latest director deals are on it. Or not. I'm sure you used to be able to do that. Can't now. About AJ Bell, will they do it? That's not what I'm looking for, is it? Where else can I do it? Market beat. Come on. Ownership. Come on. I'm on the page. Okay. Am I on that page? That is just telling us this. Yeah. 0.2%. No, okay. It doesn't look like we've got fucking insiders. Great. Okay, moving on from that. Tell you what we'll do. I'll drag it in here first. Let's get back to the have we got downside protection? Because I'm doing a lot of fannying around. Keen on the fannying around. We don't have enough time as a standalone investor to do a lot of messing around. It would be nice for one day. Monish Fry said he might do it. He's got like a 72 page thing, criteria that everything's got to reach before he purchases. We are significantly below tangible book. Significantly free cash flow as well. Supposedly 455. Historically, there we go. This is the problem. The yield to EV is not great. It looks amazing on market cap. 32%, 44%, but as soon as you put the debt into it, the multiple goes considerably higher. And it is historically always traded around an 8 times multiple. And it's a bit of a value trap in that case, then it's always traded around this. Because of the... Oh, look at that. Wow. Cash minus debt. effectively net debt minus $27, $26.50. Interest coverage, that was quite decent. So you're cheap on an asset play, not cheap on cash flow. Return on capital is not great either. I mean, look at that, 2023, return on capital 1.73%. Been better off sticking it in the bank. Yeah. Okay, so we've effectively said that this is a no. The simple free cash flow margin's amazing, but the debt, what's the long-term debt all done historically? Stayed very similar. There's been no real attempts to cut that down, has there? Cash is slowly grown. Size of the business has been very similar as well since 2017. We're talking a decade. What was the share price done in that time? I mean, it used to be way higher. Oh, look at that. Right. Not that we believe in the hoodoo of technical analysis, but top to bottom, bottom to top. At the top, down the bottom, at the top, down the bottom, at the top, down the bottom. Next destination at the top. Technical analysis, this is. We have as well the top of this channel. The retest at the top of this channel is also the retest of the middle of the long-term downward trend. So, on technical analysis alone, are you going to fill that out with time, or is it going to increase? What's their dividends like? Divs per share, very. Ooh, really fell off my bloody desk then. I'm not a huge fan of this straight off the bat. Yes, there is downside protection. Even after the debt. Let's just see what is the long-term debt thing. Partnership had the following debt outstanding. Term loan. Is that for these vessels, or are they the collateral? Years. That's their vessels. So, I'll spell that. Collateral. No, can't even spell it. Look. Oh, I had it right fucking first time. Collateral for their debt. Is this the case? And if so, which is there a list of which vessels or which portion of debt? Let's just have a look as well, right? We're on their website. Let's just take 2022 Suezmax oil tanker. Last sold Suezmax tanker price. In 2004 and 2005 combined net price for so 25 million for a fucking 23-year-old ship. 40 million two Swiss Max new builds were sold for a record price. But they're new builds. So I don't know what you would say. About 100 million new, and even 20-odd-year-old ones are going for like 25 to 40 million. What would that be worth? Like 70 million, 80 million? There is a website. I found a website before that sells oil tanker for sale. Ship selector. Is this it? No, I don't think so. That wasn't it. Trucks. Horizon ship brokers. Nope. Alright. It doesn't matter because I'm not overly interested anyway. Oh, this might have been a website. Prices on it. Can we see prices? Oh, yeah, some's got it. I don't know. Tanker year from 2022. Go. Have they got anything? LR2. No, they haven't. 2020. No. Alright. This can't be the website then, because I've seen one recently with loads on it. How many they got? 1, 2, 3, 4, 5, 6, 7, 8, 9, 12, 19. I don't know what price you'd assign to them because some of them are older. I mean, it would appear, if I just did 19 times 65, so 1.2 billion, it would appear that their own valuation is probably pretty accurate for the actual prices of ships. Where are we there? What did they put? 1.5 billion. Yeah. So your tangible book value could actually be quite accurate. What's the maturity on the debt? Doesn't say, does it? Oh, does it? Here we go. Sale leaseback. Balloon repayment 2026. What's total debt? Total long-term debt? 735. Plus 179, okay. I don't know, they don't tend... No, I think it's just going to be a no again. We could go quite deep into this. I did on another oil tanker one semi-recently in a semi-recent video. I think we're going to pass. But another 25 fucking minutes on it though, by the look of it, on something else we said no to. So my learning to say no fast thing is really not going very fucking well. So yes, there is potential for decent upside on assets. You would definitely have downside protection from this business, but the cash flows are to the point where you are, what's the historical average over the last 7 years? 9. So there's no upside there really, other than another... There's no upside there really. You're already trading around about fair value on cash flows. And I think you can sort of tell that with the price by the slow grind. So yeah, for me it's no. no downside protection. Well, there is downside protection, but the downside protection is severely limited by the cash flow multiple. Dividends were what? 31 cents a share. They've dropped significantly compared to historical averages. Tax cash flows have dropped. Not really, no. Just decided to pay less dividends. It could be to do with their debt, maybe the debt doesn't allow it. Yeah, there's nothing in it. Well, it's not that there's not nothing in it, but it's just purely an asset play, and it doesn't historically seem to have mattered too much, the price of the assets. So, no, for me. Yeah, nobody outside of these people are very big on it at all, are they? Insider, don't we? Open insider. Right. Ooh, Reddit. Ooh, 1.3 million. Ooh. I mean, there's not a lot of data on this, is there? And technical analysis there. Oh no, here at the bottom of the channel. Anyway, stop with the fucking technical analysis. Okay, so we have looked at this, haven't we? What are these? Just fucking ignored. Ooh. Now that looks like roadkill. Paper-based packaging solutions. GPK. Quick look at the balance sheet. And then I'm going to call it a day. I might not end the video on this. But I'm going to go to bed and then maybe I'll restart it tomorrow. I say that, but when my life allows me to restart it. Oh. What's going on there? Undergo maintenance, done. Right, we're going to finish it there anyway, look. Because it's just going to do that again. Alright, good night. I'll probably continue the video next time when it shouldn't be doing this shit. Okay. See you in a minute. Because you ain't going to know the difference between the fact that probably I'm coming back to this a few days later, but see you in a minute. By magic, I'm back. It was not the next day or the day after for me to come back to GPK. It's probably been about 4 or 5 days, annoyingly. So we're just going to have a quick look through it now. I'll probably finish this video after GPK because it's going to be well over an hour, I would imagine. And then I'm probably just going to start straight on to the next one afterwards. But just looking in here, actually, the inside of buying or the funds that own it. Because I've noticed this look, 2 purchases of reasonably good size, 500,000 and 200,000 at the beginning of this month. So I was just going to see, 8% portfolio, that's interesting. 4%, 4%, 4%, well, it's almost 5. Okay, so there's some Greenlight Capital. Why do I know Greenlight Capital? There. Have they changed their name? Oh, look. That's a, yeah, Einhorn. Is that him then? It's got to be him, isn't it? This is a, I got on to Einhorn by Keith Gill's videos, Roaring Kitty's videos, because Greenlight is one of the funds that he used to follow. In fact, if you look at all of these down here, other than Himalaya Capital, we don't have on there, there's Monish Probright, I don't think. Other than Himalaya Capital, which is Li Lu, almost all of these were just screenshotted straight off of Roy Kitty's list, as were these. And as you can see, Greenlight is there. So has Greenlight Capital changed its name? No. DME Capital. Greenlight DME Capital. So it's definitely owned by him by the look of it. Let's click on it and see. Einhorn, yeah, David Michael Einhorn, Capital Management. Okay. Investment strategy, long and short, publicly listed securities, macro and distressed debts. Just so you're aware, I've still got a bit of a cold, so I am going to cough in a minute. Or much sooner than a minute. Alright. Interesting. Oh, 20% of their portfolio in GRBK. Green Bricks Partners. Interesting. The GPK is actually quite, I mean, this is huge. This is a huge position. But this ain't much smaller than the rest of them. Is it? 45 positions is a lot. I mean, it's not an entirely concentrated portfolio, that one, but generally all the big returners have very, very concentrated portfolios. But yes, piqued my interest now. Einhorn's in it. So straight to the balance sheet is what we normally do. Cash and equivalents, receivables, inventories. Designs and produces paper-based packaging solutions, by the way, especially for food, beverages and consumer goods. Food packaging, beverage packaging, food service and packaging, household and personal care packaging. So yeah, I guess why it matters today, there we go, important because the shift towards sustainability. So yeah. Sustainable paperboard alternatives, yeah, there we go. So yes, there could be some growth in this, couldn't there, with the way things are going. 2 billion in goodwill is quite high. 261 million, you've got to count that in full, haven't you? Cash, it is full. Receivables, inventories, I don't know what you count as inventories. I can't imagine the inventories are staying very long on the books. I haven't put this in. Let's put it in here. Because if I do my day sales of inventory, not that it's entirely accurate, but you might get a thing of how long inventory stays on the book, because the longer inventory stays on the book, the more of a discount you need to keep on it when doing talk about liquidation analysis. If inventory takes longer to get rid of, then it's worth less in a fire sale. Is this in properly? Right, we've got it in properly. Oh, I don't like that though. $2 in tangible book. What are we looking for? Day sales of inventory, 100 days, 3 months. And it's slowly crept up as well, look. Day sales of payables are not too bad though, are they? When you look at what the average is, there's a bit of manipulation here and here, in that all of a sudden it took a lot longer to pay off the payables. Day sales outstanding, those around about average, so they seem to be running their receivables and their inventory Not the inventory's got worse, but their receivables and their payables on a reasonable scale. So I don't know what you would take for inventories on that. Maybe 80%. I don't know. It'd be like 1.4. 1.4. Say 2.4. So 2.4. Depends what their profit and plant and equipment is as well, doesn't it? We'll take it at full value for now. Even though it isn't going to be, it's going to be quite specialised equipment. If you're going to sell it in a fire sale, you're going to need to sell it to somebody who's also in the same business as you. What do we say, 2.4, so 8 billion in assets minus, there you go. In a fire sale, there's no downside protection. Now, I try to look for downside protection. This is like a Michael Burry, Monish Pabrai. Is it Greenblatts so much? I don't know. Like Michael Burry has said that sometimes you don't need a catalyst, sheer outrageous value is enough. So that's basically saying that if it's worth so much less than the assets, that can be enough to be an investment in it. Now, obviously, you need to look at the direction of the business, because if it's dog shit, then it's going to go, potentially going to go bankrupt. But if the assets are so high and you're willing to wait, you could end up with something after the debt holders are paid. So, and Monish Pabrai as well, a lot of his stuff is asset based and then earnings based. So where are we? This one here. So liquidation value, reproduction value, or great returns on capital. So we haven't got any of this. This is negative, so it's not good. I don't like that. Reproduction value, be difficult without going into what the assets are to see. But the next thing for me I normally do is if it fails this, I'll look at this and see how long on cash flows it would take you to purchase the business, because cash flows can be so high that the debt and the negative value and all that doesn't necessarily have to be a problem. This is the 10k as well, isn't it? So what have you got there? 841. Capital spending was higher than that though. The only reason they got positive is because they sold receivables. I mean, they'd have positive free cash flow, so free cash flow minus, well, this would be net cash, interest, operating activities minus investing activities. Sometimes there's a more conservative free cash flow, but in this case, capital spending is actually higher than that, which is, what's that? How many years running is that? 2 years running. So we're going to see 2 years ago started to go down the Swanee. We are, see. And now, from a technical analysis point of view, we're breaking below this level here. Potentially we're going to keep going lower. I mean, where's the next logical stop? Down here? 5, 6? Maybe in there, look. This is purely technical analysis here. Yeah, next logical stop's there. Could be looking at like 7. Does that have any credence going further back? It does. We do some technical analysis. We're almost there, aren't we? After that, you are looking down here at like $5, $5 to $6, $5.50. This is I don't really know what to make of this now, actually, because they've had about 700,000 in insider buy-in. Maintain it underweight. Sector perform. I can't. they've had less operating cash flow than they have had capital expenses. Look, so it's negative free cash flow effectively. Is it negative free cash flow on my thing? Yes, it is negative free cash flow. $3.45 down to -28. Share count is coming down. Revenues are coming down. Gross margin has improved. SG&A margin's got higher though. Operating margin has improved. Simple free cash flow margin is tanked. Book value is improved, as has tangible book value. But there's no downside protection from tangible book value. No interest coverage ratio, and hasn't been a particularly good interest coverage ratio for 3 years. I'm not sure that I can be interested in this, to be honest. Go look at the enterprise value. Is that correct? 2 billion, 2.6 billion market cap. 2.6 billion market cap. Yeah, it must be like 7 billion. Only 261 in cash. What have I got that as? Enterprise value as 7, yeah. That is the correct enterprise value. So for me, it's a no. Straight off the bat, I want to pay. This is a much for Riley Lou thing in that you want a business to be able to buy itself reasonably quickly. I'm sure Nvidia recently was trading like 158 times earnings. So if you were to buy the business out, it would take you 158 years for you to turn a profit just from its earnings, which is crazy. You're not going to see a benefit from that. Your kid's not going to see a benefit from that. There's a chance your grandkid ain't going to see any benefit from that. So why is it a good investment? And I think as well, if you look at it statistically, the average business in the S&P 500 only lasts about 50 years. People like Coke, General Electric, McDonald's and all that are outliers. They're not. Look at I think if you go back 100 years, the only company that's still in the Dow Jones is General Electric, I think. I could be wrong on this, but I'm sure I've read that somewhere. So in 158 years' time, is Nvidia going to be around? So I like to buy business. I like to look for businesses that are going to pay you back very quickly. And that's a Monish Pabrai and Lee Lu type thing. If you watch Lee Lu's Bruce Greenwald lecture, when he bought Timberland was like a 50% cash flow yield. 2 years and you've got your money back. Monish Pabrai says that he likes to buy stuff that's going to pay him back in 3 years. So if we're looking at this, almost 8 billion in enterprise value, and even if you had positive cash flow back here, you are talking years before you would turn a profit on this as a business. And as a value investor, I have to, I'm sorry, but I have to look at it as if I'm buying a business. So for me, this is a no. I will quickly read, see what anyone else is saying on this, because when did Einhorn get into it? First quarter purchase, 2018. Is that him, Einhorn there? No, this one here. 2021. What was it doing in 2021? We were down here in 2021. Yeah, here. What was it? Q3 2021. Q2 2021. So, around here, must have bought on this breakout. Around about here, maybe. I mean, it did really well for a period. What have we had now? Peak to current price, 70% drop. That's 2 years worth of bad cash flows, bad free cash flows, which we can see here. Capital expenditures were bigger than earnings, and earnings have gone down and down and down. Revenues have dropped at 9.4 billion, 8.8, 8.6, less of a drastic drop here. Cost of sales are higher than they were last year. SG&A, so they are cutting costs. SG&A's gone down. Oops. What's the difference there? Cost of sales. Yeah, 200 million in cost of sales. Look, it's the difference between that and that. Interest expenses around about the same. So all of a sudden, it's just this small drop in revenues. I mean, it is a small drop in revenue, especially compared to this year. And all of a sudden, that they're not in a particularly good place. Yeah, I don't like this. Moaning for Bryce has got to beat you over the head with a stick. Say, look at me, look how cheap I am. GPK buy in January. Focus on the big picture justifies upside. CapEx heavy consolidator to a cash flow compounder. That was last year. He's lost some serious money since this one. It's going to load. I didn't click it properly. 50% down. With a buy rating and a 25% upside target. This is why, so with 20%, 8% upside, this is why Monish Babrai, Michael Burry and all that, they don't look for upside of 28%, because if you're wrong, look how much you can lose. They want doubles, triples. This is what Keith Gill was saying. They want doubles, triples, because even if you're wrong, you could still make 30%, 40%. If your thesis, if you're confident in your thesis, but the market doesn't agree, there's still a chance you can make some money. If you're looking at minimal upsides and you're wrong, you're far more likely to get whacked by it. I don't know. The market's not having it, is it? This is a falling knife. It would be interesting to see. Maybe I will mark it, because it would be interesting to see if we get a bounce around this area. I mean, there will be people looking for this 20% there. A bounce potentially. By the look of it, what's more likely to happen is it'll break through here, go there, and then come down here. Well, here. Don't know. Technical analysis, that is. Don't rely on it. It's all voodoo. What did the guy in January see? Buy despite 47% price drop. More than that now. Price of publication. Fuck. Market guidance 2025. Capital spending 850 million. That's what's just come out though, innit? When was this? When did he write this in January? This might have already been out. I don't know. We don't know. It's not for me. It just isn't like future forecast or GPK. Typical price target 14 to 18. That's a double. Bull case 25 to 35. 8.5 billion. Long-term growth is very slow. was declining and then growing. Forecasted decline. Cash flow and business are expected 700-800 million free cash flow in 2026. Really? Negative free cash flow at the moment. That's a hell of a swing. This I agree with, yeah. That is an accurate statement. Strong cash flow, high free cash flow supports dividends and buybacks. Free cash flow is currently negative. $841 CFO versus 922 CapEx. How is that strong free cash flow, and are they really predicting a 1 year swing of negative free cash flow back towards, where did we read it? 700-800 million. Is going on underneath it. It's not basically negative, it is negative. Why management still talks about strong free cash flow. Okay, alright, so they're building something. Hence, potentially normally large debt. CapEx of 450 million. Okay, well, it's coming from them, because that's what ChatGPT is using. Look. Free cash flow guidance. Okay. 450 million improvement in CapEx. So what is normal CapEx? I mean, it was back here. Okay, yeah, alright. So, what was the market cap? 2.6 billion. You're still going to be looking at like 5 years. And that is really ignoring the debt and buying at market cap. Inventory reduction plus working capital release. Has inventories grown, have they? Yes, they have. Significantly grown when... Okay, well, revenue's more than doubled from back then. But that would suggest that there's still too much inventory, right? You're doing 4.4 and you only had 634 in inventory, and now you've got 1.7 billion in inventory, and you've only less than doubled the revenue. So yes, there's probably too much inventory. Temporarily inflated. You can't count one-offs. You can't. So they're counting a working capital. Can't count one-offs towards free cash flow. That's not indicative of the business true reality. What's actually happening? CFO is depressed, CapEx is inflated. Okay, I do appreciate this. CFO is inflated by working capital release. CapEx is temporarily low. Normalize it properly. I mean, I'm not doing any of these numbers, but say it is 300, we're just going to have 300 million. You still got to pay for this. 10 years, 20 years, 25 years to buy the business out. Not for me. Not for me. GPK, no from me. So there we go. I get there's a thesis. Long-term sustainable packaging seems like it is the right way to go. If they've built a factory and they're going to come down, fine. Can't count the working capital release. If they've made too much inventory, that's on them. Even then, you're still looking at a long time to be able to purchase the business. I mean, I'd be interested down here, but I ain't interested up here. Anyway, I'm going to leave this video there. Or we're just going to crack straight into another one quickly. See where we go from there. So thank you for watching. Please like and subscribe, and see you on the next one.